My name is Jennifer Cunningham, and I'm the AVP for Alumni Relations here at Lehigh. And we're here today for a Mountain Talk webinar with two finance gurus here at Lehigh, Kristin Agatone and Pat Johnson. I had the pleasure of seeing this presentation out in San Francisco at our new NASDAQ Entrepreneurs Center. We had about 40 people out there, and it was so well received that we decided we would take it to the masses and offer this via webinar. So the success of these webinars depends on your involvement, and the way that you can get involved is to type questions and suggestions and chats down on the lower right hand of your screen. Just type in your question or your comment, and I will read them aloud to the speakers so that they can concentrate on answering your questions. That's about it. We'll go for about a half an hour, and at the end you'll see a survey pop up, and we are hoping that you will give us some feedback. We've been doing these for a little while now, and every time we get better because of your comments and suggestions. So let's get moving. So Kristin, we'll start with you.
Great, thanks Jennifer, and thanks for everybody for joining this afternoon. We're going to start off, I think, briefly by going through some slides. And then after that, we want to make sure we leave plenty of time for Q&A and all of your questions. So I'm going to kick it off just with a little bit of background on the endowment and our investment office that I oversee. And so just to start off here, you'll see the endowment is the university's largest asset at $1.3 billion. It supports a wide range of programs and financial aid and faculty endowed positions that are very important to the university, and Pat will be talking a little bit more in detail further on in the presentation about some of those specific examples. So the investment office, we're about a team of 5 people. We opened an office in New York City as of January of last year. We have, the way I describe it, 2 key focuses for the work that we do. One is to provide intergenerational equity, and so to make sure that the endowment is a ongoing resource for all future generations of Lehigh faculty and students and staff, but also we need to make sure that we're contributing toward the annual spending that the university does. And so we need to balance those 2 on an annual basis as we think about our asset allocation and liquidity within the portfolio. If you kind of boil that down to what does that really mean from a return perspective, we're talking about, say, a 6 to 7% annual return, which would let us to both make the distributions from the endowment to the university on an annual basis, as well as maintain the corpus of the endowment into perpetuity. We, as an investment office team, really focus on setting what the right asset allocation is, the risk and liquidity profile to match the university's needs, and then specifically underlying that, we really focus on how those get invested across what for us are 5 main asset classes. To date, that has primarily been through using external managers, but we also use passives and separately managed accounts where appropriate. The way I describe it is that we'll always think about passive as our default, and then if we can find active management across all of our asset classes, we will certainly do that, where we hopefully can add value and generate a higher return through active management. The investment office, which we our team on a day-to-day basis is really looking over the portfolio, is also overseen by an investment subcommittee, which is comprised of 8 members, all alumni currently of the university, and they report into the finance committee. And so they're really the ones that we meet with on a quarterly basis. We walk through them, what our asset allocation liquidity profile is. We talk about what the investment opportunity is, our overall view of the market opportunity and the risks that are currently out there. We actually happen to have one of those meetings today here on campus with that group. So just very quickly, but I think the most interesting part about the history of the investment office, which some people, certainly alumni, will appreciate, is that in the early days, back pre-1979, it was endowment was actually overseen by Bethlehem Steel's pension group. But in 1979, that's when it was pulled out. It was then overseen by an investment subcommittee managed by, which was a subgroup of the board. And then in 2007, when the endowment got around or over $1 billion, That's when the investment office itself was set up to really focus full-time on managing the portfolio. And that's when the first CIO was hired. I was the second CIO that was hired a little over a year and a half ago in 2016. And since then, we've made a number of changes I alluded to as far as both the geographical location of the office and certainly on the portfolio side and on the team side as well. The next two pie charts just it would probably be helpful as people think about their questions. Just a little bit of a reference point. On the left-hand side of the pie chart you see is our target asset allocation. Given our target returns of kind of in that 6 to 7% range, we will, like many other university endowments, be equity-oriented. Those would be the public equity bucket, which is 45%, and the private equity bucket, which is 20%. So think about us about 65% equity-oriented portfolio. With the other asset classes that sit around those, absolute return, real estate, cash and treasuries, those are really the diversifiers in our portfolio. Total return focused, sources of liquidity in a market downturn, hopefully as uncorrelated as possible to the equity portions of our portfolio. You'll pick up, hedge fund primarily would be in that bucket for us, although they do also sit a little bit in the public equity bucket as well. On the right-hand side, you can see the pie chart of our current allocation. We are a little bit different than the target, but not significantly. I'd say the biggest areas that we've been overweight public equity recently, which is actually for the last year and a half or 2 years certainly has been helpful for us. We are taking risk off candidly and rebalancing as the equity markets have continued, public equity markets have continued to do well, and happy certainly to talk more about that as well. Absolute return and real estate continue to kind of be significant portions overall our portfolio, and we're always looking to make sure that those are balanced compared to the public equity and the private equity portion. That's our longest duration asset class. We are making commitments and investments in that bucket that will last 10 to 12 years. I'm not going to spend too much time on this slide, but this is just a reference slide to give you a sense of kind of how we conduct our work on a day-to-day basis. We are very much research oriented in the work that we do. We're always thinking about what current investment opportunities are out there. Do we have exposure to those in our portfolio? What is the best way to access them? Active, passive managers, that are based in the US or geographically different or sector specific. And so those are all something that we are always monitoring, both existing investment opportunities or investment positions, as well as other future potential opportunities that sometimes we're tracking for 3, 5+ years and getting to really figure out if they're the right fit for our portfolio. And the last slide that I have here is just a little bit of context on performance. Most recently, 1 year, our fiscal year ends in June, and so that's where you see the dark bar on the left-hand side is the performance of our portfolio compared to our reference portfolio. You can see certainly in the last 1 year, a strong supportive backdrop of equity markets more broadly. Candidly, we're up about 15%. We're up exactly 15% for the fiscal year. We've continued to benefit from just a robust market environment for the last several months since the end of the fiscal year. Those dotted lines that you see on the graph there, those are kind of reference points for us, kind of where the target is to, as I referenced before, achieve both of those objectives as far as both support the current spending needs as well as kind of the future intergenerational equity that we look to achieve, which is around that, say, 6 to 7 to 8% type of a target range. We have a very long-term orientation. So when we talk about stuff on a 1 year or 10-year basis, 1 year seems extremely short for us. Typically we're talking at least kind of 5, 7, 10 years as far as our outlook with our portfolio, which is actually also an asset for us. And so at this point, I think I'm going to hand it over to Pat.
Okay, thank you, Kristin. My name is Pat Johnson. Good afternoon, everybody. And I'm going to talk a little bit about technicalities first, and that is, what is an endowment? It's certainly a term that we throw around all the time. And when we talk about it here at the university, we're really talking about true endowment. And as Kristin said, it holds its principal in perpetuity, but it only pays out a small portion based on a spending policy. The endowment fund is a pool of money. Thousands of individual funds are included in that, and we talk about the generation of income again. And then here we're talking about the types of endowments. There is more than one type. True endowment is the one that's in perpetuity. Quasi is money that the university has set aside at some period in time for future savings or spending. And then term endowment has a time period to it. It's not required to exist in perpetuity. The spending for the endowment fund depends on the policy, and it can be between different institutions between 4 and 6%. And withdrawals can be made from the unrestricted portion, which is not endowment. You cannot withdraw from true endowment. The gift sources are cash, bequests, life income, remainder funds that come in. And this is a breakdown of what that endowment is used for. This is probably the most important part of this presentation because this is how we spend the money. So a large percent of this comes from, goes to scholarships. At Lehigh, a large go to chaired positions or professorships. Fellowships is another, you see endowed chairs, and then a portion is unrestricted. 32% of that is. Scholarships makes up the biggest use of our endowment fund. And then just to give you an idea of what impact the endowment has on the operating budget, the endowment earnings down at the bottom, 13.5% of the operating budget. The majority of Lehigh's revenue comes in from tuition and fees. We do have other investment returns. We have research grants, contracts, gifts you can see there, and then auxiliary services. And our total budget is about $505 million. The total spending from a true endowment, you can see again, restricted. We have some of it is to faculty salaries, financial aid's a large portion of that. The operating budget itself gets a contribution from the long-term investment pool of almost $19 million a year. And then I just wanted to give you some examples of how the endowments have helped the university. The one that everybody knows, Goodman campus, we're sitting here now on that campus. The income is used for general maintenance and improvements to the Goodman campus. On the college level, we had a bequest for the Rosslyn Endowment, and that's being used for strategic initiatives. That just came in last year, as a matter of fact. Other examples of endowment spending, we talked about Goodman already, but financial aid is, again, a big portion of what we spend the money on, and we have a gift from the Stabler Foundation that allows us to use income from undergraduate scholarships. Just an example of some of those gifts that we receive. And then I think my next to last slide is how important it is for financial aid as a part of the university. You can see most of our financial aid comes from operating funds. We actually like to change that balance, have more of it come from endowment, because this again is the biggest expense next to salaries that we have at the institution. And then this is just an idea of what that financial aid support can do. Over 1,000 students receive endowed scholarships. Stabler is 383 of those. And then 120 students receive sponsored scholarships as we talk about that. So then I believe that's the last of it, and we can get questions.
All right, thank you. We have a lot of questions. This is fantastic. Just a note, if you didn't see it in the chat, we will be sending out this slide deck to you afterwards, so you have those pie charts and the slides later. Okay, so I'm going to go down the questions here. From Kevin O'Neill, have you looked at corporate-owned life insurance?
I assume this is a question within our investment portfolio. Yes. We have not directly looked at it. I would say that's probably something that a number of our managers, though, have. Mm-hmm. We have to balance as far as what we look at in the portfolio, both with breadth and then as far as being very specific. And so sometimes we find that's a great example of something where probably somebody who's a manager who's really on the front lines of that is probably a better expert at that than we are.
Okay, great. A couple questions about benchmarking. John Macaulay, class of 84, what's your relationship with the peers at other universities? And then Glenn has a similar question. I think there are less than 100 college and university endowments with assets more than $1 billion. What are our rankings in absolute dollars and endowment size per student?
Sure. So I can tackle the first one, and I think Pat might have some data on the second one.
Actually, I don't remember I'll tell you why, but go ahead and answer first.
So it's actually a really nice peer community we have. One of the big reasons also for us being in New York City now is that we actually have a number of our peers there as well. And so we're actually always trading notes and in some ways, sometimes even working together on investment opportunities. that where like-minded investors can get together and help back another manager or actually help back an investment opportunity. I describe it with Lafayette. We'll have very unfriendly lunches though together when we meet. But even Lafayette with their team, they're based in New York City, and so it's actually one of the big pluses as far as a very nice community to be a part of.
Okay.
And I'll answer the second part of that question in general because I don't have the exact number, but I think we're like at around 175,000 per student for endowment dollars. The reason why I've even I'm looking at it because of the tax reform, and we're under even the 250,000 limit. We're nowhere near the 500,000 that the Senate has recommended. So we are probably near some of the smaller size for the endowments. And I understand that, again, look at the tax reform as we look at it daily. There's 143 universities that have $1 billion or more in endowment. Mm-hmm. And again, I think with our levels, we're probably near the bottom of that. Mm-hmm. So the big ones obviously are the Harvards, Stanfords, that are around 38 billion. Mm-hmm. Harvard's 38, I believe.
We'll get there, right?
Of course.
Sure. And just because you mentioned tax reform, John McCauley has a question, thoughts on the tax reform proposals. Do we have anything official, or are you just kind of waiting for something to become reality?
We're waiting for that merger of as I say, we're waiting for them to squish it all together and see how it's going to affect us. And a lot of it's going to be negative, unfortunately. If it squishes out the way we think it could. If there's an excess tax, it won't affect us immediately, but it could in the future. At least if we actually hope we get to those amounts, that it could affect us. The standard deduction changing may affect the way gifts are given to the university. Certainly the P8 private activity bonds, and we weren't going to advance refund any of our tax exempt bonds, but certainly that's a consideration that affect us. And as people, some of our issuing agencies tell me, it not only affects us, but it affects them because our fees help support the municipalities here in the state, and that will also go away if we can't issue tax exempt bonds in the same way. So those are the areas that we're looking at. We certainly have lobbyists in Washington. We have a person on staff who's in Washington, so we're watching that very, very closely.
I think as Pat mentioned, it's important to think about that. A lot of the support, particularly from the endowment, does go to financial aid, and so that's why we would love to reinvest that back into financial aid and bring students on campus as well. And so as much as the excise tax right now does not affect us in the endowment, the broader package could have impacts on the university. That's what everybody's keeping a close eye on.
That might be worth a whole nother webinar.
Yeah, the other big one is whether or not graduate tuition is taxable, because our students, it will suffer greatly if that happens. Because when you think about it, they're being taxed on a non-cash benefit. Right. So that's not easy for anyone to pay. So it'll be interesting.
Glenn Oretz asks, what has been your biggest surprise, positive and negative, since joining as Lehigh's CIO? What do you see as the biggest challenges of managing the endowment?
Sure. Yeah. So on the positive side, it's actually our size and both being a very attractive partner and investor has been fantastic. And so if we want to work with a manager, we've been able to get access or partner with the people for the most part that we want to, and not to say that that's happened 100% of the time, but it's actually been a really nice advantage for us. And particularly at our size, being 1.3, we are large enough to kind of be going direct and having these positions with managers, but we're not so large that we are competing with pensions or sovereign wealth funds that we're asking for so much capacity. And so as we're looking to reposition the portfolio and continue to upgrade the talent that we have in our portfolio, that's actually been a really pleasant surprise. And also we get a lot of people knocking on our door who want to work with us. On the challenges side, I describe our portfolio as kind of like an aircraft carrier, and so when you want to change it, it can take time. And so the thing that we've been thinking a lot about is how do we bake in kind of being nimble and reactive to the markets, either through what we do or through our managers do, but also still taking advantage of the fact that we have such a long-term horizon that we are looking out for 20, 30 years as we're thinking about investment opportunities. So I think that is always the challenge for us, and that specifically as the market undoubtedly will have its cycles, we want to be able to be on our front foot to take advantage of those cycles as well. And so that's something that I spend a lot of time thinking about.
Bob Doolittle asks, what's the annual drawdown for Lehigh's budgetary uses?
The 66 from endowment, the total is about 78 million, 66 million from endowment. We have other funds that we invest on the short-term pool, intermediate side. So it's about total. Is that, I think it's right for it, right? 78.
Okay. Norm Rumpf asks, one opportunity for lesser portions of a portfolio is to find hated asset classes and place a loss limit underneath. Is that ever done?
When we define, it certainly is, and when we define our asset classes, we actually keep it to those 5 that I mentioned, and so that's actually a high level. But what it actually does is it gives us to be more nimble to move in and out, we'll call them sub-asset classes. And sometimes, whether we think simply because of mean reversion or because it's a more inefficient space, we are absolutely moving into out of favor asset classes. Sometimes that can be on the public side or the private side, so we're not always thinking about loss limits, but certainly when we're thinking about sizing of a position, we certainly think about how out of favor, what the additional downside could be, and is that something that we've kind of appropriately accounted for as we think about the hopefully what we're looking for is an asymmetric return profile, ultimately.
I'm going to skip Kevin's next question because I think that William Coder's question is kind of related. Is investing for impact suggested to me that policy would consider societal impacts such as sustainability? Is that considered?
But that's actually for the work that we do in the investment office, we look to the board and the university. The university itself, and I'm sure Pat can talk about a number of sustainability efforts we do. We right now do not have an ESG policy that sits in our investment office, but has been certainly brought up to the board and discussed. We do work with a number of managers and investment partners who do have ESG policies as well. And so that's environmental, social, and governance policies, kind of focused on sustainability. And it can mean something different to everybody, but the good news is it's still happening within our portfolio because of the fact that a lot of people that we work with also have those policies.
So Kevin's question, what's the duration of the fixed income basket?
We've been, overall we have a 10% of our portfolio can be allocated to cash and treasuries. And that treasury bucket is really the only spot that we pick up traditional fixed income. And it's tended to be shorter duration than the Barclays Ag. And we've also been strategically more overweight cash than fixed income, as well, just because of the outlook that we have for fixed income. Typically on the credit side, we're either more focused on distressed public credit or illiquid credit. And so given our return and liquidity profile, having a lot of fixed income in our portfolio, like a lot of other university endowments, typically normally does not make much sense. I know Pat will, at the treasurer's office, will also carry some fixed income, but that's much more short and short duration fixed income.
John McCauley, what are typical styles of endowment investing? What category is Lehigh compared to others? For example, I've read about investments in commodities, forests, and the like.
Sure. So I think, the styles, as people probably know, the endowment model became big when Yale effectively pioneered it with David Swensen. And so I guess if I think about what endowment style means, is that typically means it's using alternatives to hopefully create a more attractive risk return profile. That means you can take advantage of the benefits of diversification and the lack of correlation between different asset classes while still earning an attractive total return. So I guess that's one question. The other part, as far as when you get into commodities, natural resources, timber, agriculture, those are all kind of the sub pieces that we use to put together that endowment style of investing and use of alternatives. In our portfolio specifically, you'll probably see us using less on, say, the timber and agriculture side, the infrastructure side, just because the return profile isn't high enough. So what we tend to skew more to is more venture capital, private equity, meaning buyouts and growth equity, more opportunistic. We do have real estate that sits in that portfolio. Commodities, we'll typically leave that again to our public hedge fund managers if they choose to invest in that, but generally we don't like to take commodity price risk in our portfolio. We find that the return is not very attractive and is also not as diversifying as you would hope it to be having in a portfolio.
The only other thing I'll add to that, just from the macro level, is that, and we discuss this all the time, how dependent you are on the endowment income in your operating budget makes a difference of your risk profile. And then in our case, what we spend it on makes a difference in your risk profile as well.
Right.
So, and the size of your endowment, you can certainly take some additional risk if, again, that percentage of contribution is less than what ours isn't too bad, 13.5, but ours funds things like endowed chairs for professorships and financial aid. So it's very, very important to us.
So that's why in the market crash of 2008 or 9, some universities who seemed really wealthy suffered because
That's right.
they didn't have cash available. Is that-
Right, and they many of those universities have a large percentage of the operating budget based on
Dependent.
on the endowment. So,
Yeah.
so no, I was just gonna say they have a lot of money, but not thin.
Right.
So,
Right.
but
So Ken Hexter's question, given your long-term view, there was one here about from John about how does the move to expanding a healthcare college and growing Lehigh affect your roles?
it makes me want more
That's probably
money.
more of a question for Pat.
I know, I was going to say, certainly we are looking for people that share that vision with us and are willing to give donations to support those type of functions. The healthcare industry is one of the places we turn to. We've certainly done a lot of work looking at that. All universities need additional capital, all the universities, and it's just because of the age of the universities. Lehigh is 151 years old. A lot of the buildings, well, some of the buildings we have are from then, and they need to be renewed and renovated. So there's always a need for additional support from donors, especially and again, pressures on tuition increases, those type of things make a difference in what our donors can do for us. So the health college is actually an opportunity. We think that we can draw additional students. We want to grow the enrollment. We can draw additional graduate students, which is always good for reputation, but we still need the support of donors and others in order to make that vision realized.
And will that change your role, the health college?
It's not so much directly for us. I mean, we will still have the same return profile and risk profile overall as a university. Something like the health college is such a bigger project that it's not just funds from the endowment. It would be certainly donations and then other resources at the university as far as that getting up and running. Having said that, whether it's a health college or other initiatives at the university, the better that we can do, the more that becomes available for the university for all the projects.
So no pressure.
Yeah, exactly.
Okay, so back to Ken Hexter's question. Given your long-term views, how often do you measure external managers, how they've done versus their targets, and how much have you shifted since you got here? Would you bring any in-house to manage actively?
Yeah, it's a great question. So just on the measurement time period, it partly depends on a strategy. If they're on the public side, I would say typically you need at least a 3-year track record. It's that balance between how much is skill versus luck that you're assessing. Particularly if they're somewhere newer, then they might be actually still developing their strategy. They might be going through generational changes in their teams, and figuring out what their internal investment processes are. On the private side, that gets a little tougher because you have funds that last 10 years, and typically another manager is coming back to raise their next fund before you really understand how their last fund did. So the way that I think about it is that we will look at all stages of private funds. A first-time fund is probably the toughest for us, but if somebody can show that they've had a track record that they're bringing with them that they own, then we're happy to take a look at. Typically by the second or third fund, you should be able to have an assessment of what the performance and their ability looks like. Having said that, these funds are always going under changes. So even if they're in the third fund, by the time they're in the next fund 5, you're still assessing them because they might have grown in size, they might have added to the team, they might have expanded their strategy. And so it's actually a continual monitoring and assessment process for us on that side.
We have one question that we didn't get to, but if you can do it in under 1 minute, we'll still make our time.
Okay.
What are some examples of the absolute return category?
Sure. Within absolute return, real fast, we have about 4 or 5 buckets: multi-strat, macro managers, credit, and what I call idiosyncratic. So that could be certain types of financing. We have hedge fund secondary managers in there, receivables financing. It's just stuff that's as uncorrelated as possible.
Okay. Oh, and somebody snuck in a question, but sorry, Bruce, we'll have to wait because we've reached our time of 12:31, and I know you have your meeting today, and we need to get you back to campus. So thank you so much for coming up. We are here on the Goodman campus, broadcasting live. There is snow on the ground here in the Lehigh Valley. But thank you again, everybody, for coming. As I mentioned, we'll send out the recording in case you had to step away for a moment, and we'll also send the slides. And please do answer the survey. And if you do have any other questions we didn't get to, you can put them in the survey. We'll make sure that you get your answers. So thank you again, and have a great rest of your week.